Today, Your Money, Your Wealth is all about, you guessed it, Roth conversions. Joe and Big Al discuss converting from a thrift savings plan, doing one giant conversion, or converting a certain amount each year based on your age, and the math around the taxes related to a Roth conversion. Plus, just how much can you contribute to a traditional IRA after making all of your retirement account contributions? How many Roth accounts can you have? Has Big Al mentioned that he's a vegan? And we'll top it all off with a quick derail at the very end. I'm producer Andy Last, and here are Joe Anderson, CFP, and the vegan himself, Big Al Clopine, CPA.
Gary, he writes in from Rochester, New York. I'm just going to jump right in.
We're going to get right into it, huh?
I am.
Okay.
He goes, "Hi, Joe. Great show." Because this was just specifically towards me.
Oh, that's why you did this one first. Then I'm just going to listen to your answer then.
He goes, "It's very entertaining and educational." He's a financial junkie, Gary is. Love to read and listen to anything related to financial and tax planning. Started out with a dozen of radio financial podcasts. Now, this is the only podcast I listen to weekly. Look at Gary.
Wow, look at that.
In podcast number 249, of course I remember that off the top of my head.
Yeah, we talked about Roth conversions.
Yes, and we probably talked about some other Roth contributions, maybe.
Could be.
You subjected people rolling over their 401k into their brokerage IRA account when do a Roth conversion.
Then.
I do remember that. I think, Andy, you and I did that show. 249.
I think he means suggested.
Suggested.
Yeah, I know.
and
I'm just reading what he wrote.
I know.
then do a Roth conversion.
Yes.
Yes.
Yeah, but let's get the English right. You suggested people roll over their 401k to a brokerage account.
To an IRA. And then do a
brokerage
Roth
IRA.
conversion.
Okay, thank you.
And then Gary said to himself, "Wow, this is brilliant."
Right, great idea.
As a federal retiree, it's a pain in the neck to withdraw money from a TSP. You need to fill out a bunch of forms, get it notarized, send a fax in, blah, blah, blah. It's time-consuming. When I just about to follow your advice, something is telling me this may not work for me and my wife are both 59. We live in Rochester, New York. I know New York doesn't tax my TSP distribution. However, if I roll over my TSP into a brokerage IRA, then convert it to a Roth, I will lose New York tax exemption.
Will I? Question mark.
Okay, will I? We still have $1.4 million in TSP, needed to be converted, $400K in Roth, $150,000 cash reserves. I may go to the top of the 24% tax bracket this year so I can convert everything before the GA and TA ends.
Tax Cuts and Jobs Act of 2017.
I love it. In 2025. We will collect Social Security at 870 with our pensions. We'll probably don't need much more of our TSP savings. So he's going to live off of Social Security and pensions, Big Al.
Sure.
Keep up the good work. P.S. I've come from a long way. Came to the U.S. in 1982. He didn't speak any English. Worked in a Chinese restaurant 12 hours every day. Hated it.
Hated it. Yeah, I don't blame you.
Oh, I love it. Just smell that Chinese food all day,
All
12
day.
hours. I'd just be so fat.
Yeah.
It'd be awesome.
What would you eat? The Kung Pao chicken or the
everything.
sweet and sour pork?
I don't care.
At all.
Yep. He went to college in 1994. He joined the Postal Service with his wife in 1998. Took the road less traveled. It made all the difference in the world. Well, Gary, congratulations on your terrific success. And I believe it was the Chinese restaurant for 12 straight hours.
That was the start. Gave him a great work ethic.
Yeah, it was like, get me the hell out of here.
I'm going to deliver mail.
Are you a big Chinese food fan?
I used to be.
I couldn't eat it.
I used to be, and then I became a vegan, so it doesn't normally work. I guess
You could get the veggies.
I guess I could, but it's loaded with oil.
Do you like to throw the vegan card out all the time?
It affects how he eats, Joe. It's pretty much everything.
Since you asked me,
It's like, well, I'm a vegan.
that's why I'm going to live longer than you, even though I'm 17 years older.
Because I'm a vegan.
That's right.
Oh, boy. All right, let's answer Gary's question.
Okay.
So
So he's thinking get the money out of the TSP to his IRA.
Because I remember the show,
Yeah.
and what my recommendation was is that you don't have to take the money out of a 401k or TSP to do the conversion. You could directly convert from the retirement account into a Roth IRA, no big deal, but it's just kind of a pain in the neck.
Right.
You got to fill out forms, you got to do all this other stuff. I said, if it were me, I would move it from my 401k into an IRA and then have my Roth IRA at the same custodian.
Yeah, so it's much easier.
It's much easier. I'm
Right.
just saying, hey, convert 20,000 from this IRA, put it in this account. Boom, I do it online. It takes me 5 seconds, and it's over, right? And so he's like, yeah. Gary's thinking, Joe's a smart guy.
Right, brilliant.
But then
said,
he's like,
whoops,
yep,
that
whoop.
maybe it might not work for me.
Well, Gary, just FYI, I live in Southern California. I live in San Diego, so I'm not up to speed on New York tax law.
But you did some research.
No, I just know this.
I beg to differ.
I don't want to put me out there as a source.
What do you know?
Oh, boy. I believe it's a deduction. He's seen, do I lose my New York tax exemption? Yes, you would. Well, it's out of retirement accounts. You get $20,000 deduction. If you're married, it's $40,000. And it comes from all retirement accounts, not specifically the TSP, what my understanding of the law is.
Okay.
So would he lose it? My understanding is no. But I could be wrong. I would contact a tax attorney or a tax specialist
Yeah,
in New
Gary,
York.
don't listen to anything Joe's saying. The answers we don't know.
I know there's a deduction you get.
But if there, well, so here's what I do know is if you're in a company pension plan in the state of Hawaii, it's tax free. I do know that.
You know, and if you go to Guam and
That's
order
right.
a chicken,
So Gary, if you move to Hawaii, but it's still a TSP.
here's what I do know.
It's a TSP, so
I'm
it
a
still
vegan.
still doesn't. Yeah, I'm lightheaded. What do you, give me a break. There's no-
Gary, I have no idea about the tax law in New York, but what I do know
yeah,
is when I move to Hawaii soon.
yeah. That's right. It's coming up. Anyway, yeah, check with a local expert on that one. Because if there is a benefit that you'll lose from doing this, you may
You
not
don't
want to
wanna
do
do
it.
it.
And you're right to sort of have take a pause on this.
But here's what I would do is that he's got $1.4 million, I believe, I think is what
In
he
his
said.
TSP,
Yeah,
yes.
it's still in his TSP. So maybe he does, I don't know, how old is he? 59, right? So he's got another 10 years. He doesn't need the money.
Right.
He's living off of Social Security and pensions. Maybe he moves $700,000 of the 1.4 into an IRA. He
Right.
keeps $1.4 million in there. He converts the $700,000 over a 10, 11-year time period or before the Jobs Act. The Jobs Act.
I never heard it.
TCJA.
But
Tax Cuts Jobs Act, yes.
Yeah, Jobs Act.
Jata. The
Jata.
Jata.
The Jata.
Jobs Act, Tax Act.
Jobs Act, Tax Act.
that's- we knew what he meant.
It expires in 2025. So he could take a partial, right? So just to keep his conversions kind of easier versus if he's going to do, let's say, the top of the 24% tax bracket, that's a pretty big conversion, Gary. So just kind of take a look and saying, all right, well, how much money would I want to convert over the next 10 years? Maybe you take that out of the TSP, you move that into an IRA, you keep X amount of dollars in the TSP so you wouldn't lose any type of tax exemption that he believes he may have by keeping it in the TSP, which I believe it would still work in an IRA. And it's just
you
a
do.
tax deduction from the state of New York.
But we're not sure.
But no, don't quote me on that. Please
a
consult
guess.
your tax advisor.
Now, if you had a California question or Hawaii,
Yeah.
we can help you out.
Or what? But a couple of other things, so they changed the law, right, on TSP when it comes to taking distributions out. It was like you had 1 year to do it. You could only take a distribution once a year. And there was all sorts of different types of restrictions.
Sure.
So they changed that, but there were some surprises that I saw.
And this is federal, not just New York, right?
Yeah, federal.
Yep.
So with TSP, some drawbacks remain here. There is no stretch option in a TSP. Did you know that?
Did not.
So in an IRA, if you pass away, the beneficiary can stretch out the tax liabilities over the beneficiary's life expectancy. Currently.
That may change next year.
That could change. But right now, if good old Gary passes, hopefully not.
Yeah, but if he
But
does.
he's got $1.4 million in the TSP plan. His beneficiaries may not be able to stretch that if they're non-spouse. So I thought that was like they can't do a 72T tax election in a TSP. You cannot do straight to charity from your required distribution.
Qualified charitable distribution.
Out of a TSP.
Okay.
So
look at you.
Yeah, a few other things to consider.
Is that a recent article you're quoting, or was that something written 10 years ago?
This is called, this is November of 2019.
Okay, good. We're up to date. Just ask.
We are solid. So if you got money questions, don't ask us.
Please don't ask us.
Especially, only if you're from Hawaii.
Yeah, that's what I'm good at that. Okay, so we got like 12 pages of email questions. So where do you want to go?
Well, let's talk to Andy. Where does she want us to go? Because she put it all in order, and then we blew it up with Sherry.
Totally blew the whole thing
started
up.
with page 5. You want to go back to page 1?
I was going to say, why don't you stay on page 5 and do ZC from Washington State?
Okay, ZC
right.
from Washington State.
Let's do it.
Right. I don't even know where the hell page 5
5.
Got it?
Okay.
Boom.
Okay.
ZC. ZC. That's kind of a cool name.
That's a great name. From Washington State.
Hello, Joe, Big Al, and Andy. I have a question regarding 401k and IRA. I am participating in my company defined contribution plans, Roth 401k, and after-tax contributions within the plan. This year, my contribution and company match will total $62,000, which is maximum allowed. With that in mind, can I also contribute $7,000 to my traditional IRA on top of the $62,000 that I have with my employer? Thanks for the great educational show. ZC. Well, first of all, Al, let's talk about the $62,000 she is claiming she is contributing to her plan.
Yes. So there's that.
Because most people would, even our 401k
doesn't let us do it.
would be like,
They told us we
you're
couldn't.
crazy.
So let's talk about that. So first of all, an individual can contribute $19,000 to their 401k, and then there is a $6,000 catch-up if you're 50 and older. So $19,000 plus 6 is $25,000. That's the amount you can contribute. That would be either to a deductible 401k or traditional, or to the Roth 401k, or any combination getting the $25,000. Now, then if your employer does a match and or a profit sharing component to this, it can get as high as $56,000 in total going in for you. So you contribute, let's say 25 if you're 50 and older, and then the employer can get up to $56,000. Actually, if you're under 50, and if you're 50 and older, $62,000. But there is another way to do it, which is not commonly known, and that is some 401k plans allow after tax contributions to get up to that $56,000 or $62,000, and it looks like that's what's going on, because in parentheses, Roth 401k plus after-tax contributions within the plan.
So ZC, she's or he.
Yeah, we're assuming ZC is female. I'm not really sure.
I don't know either. I don't know. Whatever. ZC.
So one thing we know about ZC is he or she is over 50. Because
so
the number
ZC is putting in the.
Yep.
And so this is a really cool strategy that ZC's doing.
Yeah, agreed.
Is that all right? So it looks like ZC's putting the money into the Roth. And ZC, please write me back to see if you're a boy or a girl, or male or female, or you could be whatever.
You're just cracking yourself up today.
Oh, and so what ZC can do, so Roth 401k plus after-tax contributions within the plan, so those are after-tax dollars. So what you can do with after-tax dollars within a 401k plan, because they've already been taxed, you can convert those directly into a Roth IRA with zero tax due, because you've already paid tax by going into the plan. So it's a giant way to get a large amount of money into a Roth IRA. We call it like the garage back door, you know? It's the garage door.
I think that's a different name, but I forget what they call it.
It's a giant back door.
Mega Roth? Mega back door?
Mega Roth door.
That's the word.
Roth.
Mega Roth. Mega back door Roth. That's what it's called. So at any rate, so sounds like $25,000 is going into the Roth 401k, and then X number $1,000 to get to $62,000 is after tax. And you're right. So that can be converted directly to a Roth IRA. It depends upon your plan how soon you can do that, though, right? Because if you're 59 and a half and your plan allows an in-service withdrawal, you can do it each year. But if you're under 59 and a half and your plan does not allow in-service withdrawals up to that point, you may not be able to do it.
Yeah, it's always up to the plan document. And then I guess her main question, or his main question, is $7,000 into the IRA.
Yeah, you can do that.
Of course.
Sure, because it's a different number, different limitation than the 62,000. So yeah, go for it.
It's all up to adjusted gross income and age at that point.
Yeah, so you have to be under 70 and a half.
And then so if you're under 70 and a half, you can still contribute to traditional IRA. It sounds if you're putting $62,000 away, probably a high wage earner for someone to save that much money into a 401k plan.
Could be, yeah.
And then from there, you're not taking the deduction. Then you could do a conversion from the $7,000 non-deductible into a Roth if you're doing that. So, yeah, you can definitely do the traditional IRA or a Roth IRA depending on your AGI limitations.
Correct.
So let's go to page 1.
Okay, you just...
Would you like me to ask the question?
No.
Okay.
Okay.
I would like to go to Helen.
Helen.
Okay.
Good morning, Andy. Love to see Joe and Big Al on TV again. Well, thank you, Helen. I don't think we've left.
Yeah, we're still there. We're on reruns.
Glad don't have to wait until January of next year. How many Roth IRA accounts each person can have? Thank you. Have a great day. You can contribute to as many as you want, but there's the dollar figure that's what's important.
Well, if she's asking, can you have more than one Roth account? The answer is yes. You can have 100 Roth accounts. But in terms of what you contribute, that's based upon $6,000. Unless you're 50 and older, then it's $7,000. But yeah, you could have 10 different Roth accounts if you wanted. I can't really think of a reason why you'd want to, but you could if you wanted to. There's no limitation on the number of Roth accounts that you actually open up. But there is a limitation to how much you can fund into a Roth on an annual basis, and that's at $6,000 or another $1,000 catch-up if you're 50 and older.
Helen is watching encore presentations of the YMYW TV show Season 5 here in San Diego on CBS 8, Sundays at 6:30 a.m. Production on Season 6 should begin in January. In the meantime, if you can't get enough of YMYW, binge all 5 seasons of the TV show at yourmoneyyourwealth.com or subscribe to our YouTube channel and watch all of our new episodes and videos as soon as they're available. Click the link in the description of today's episode in your podcast app to go to the show notes, where you'll find links to the TV show, our YouTube channel. You can also download the Roth IRA Basics white paper from the show notes for free. Find out what a Roth IRA is, how it's different than a traditional IRA, and why Kiplinger called investing in a Roth IRA one of the smartest money moves a young person can make. It's the holiday season. Perhaps the young person in your life needs a Roth IRA Basics white paper. No? Okay then. If you have money questions, click the Ask Joe and Big Al banner in the show notes and send us a voice message or an email, and the fellas will answer right here on YMYW.
Okay, let's go to Leanne.
Lene
from Alaska.
Alaska. Maybe probably Anchorage. That's where the most of the population is.
Could be. Hi, guys. Thanks for broadcasting your podcast. So much of
So much of what you discuss pertains to me.
Thank you. I was just thinking about Al's comment. I have a follow-up question from a recent podcast regarding Roth conversions. All right. Imagine that, Al. We talked about Roth conversions on this show.
It's hard to believe.
My husband is 53 and I'm 49. We are self-employed and we have $1.5 million saved in, about $320,000 in Roths, about $800,000 in IRAs, $250,000 in money market.
Yeah, I'm going to say money market too. It just says MM. I. Money market investment. I
Yes.
Ah,
Okay. And then individual stocks, $100,000. All right. So let's see. In a few other accounts, HSAs, they also have $1 million in real estate. Part of our self-employment is vacation rental property we own and manage ourselves. Brings in about $100,000 annually net. My husband is the remodel construction business. We do not plan to retire, close our vacation rental property when we get older, but my husband will slow down on the remodel business in about 5 years. Our annual income is about $200,000, and we have zero debt. All properties are paid for. We have a 19 and 16-year-old. College, for the most part, is saved, and we will pay for whatever we haven't saved directly. No loans. On average, we spend about $80K per year on daily living and have invested about, so they invest about $15 to $30K into retirement accounts. We are interested in converting our IRAs to our Roths and would like to know if we should do that all in 1 year, over 5 years, or what period of time we should do that based on our age. I hope I've gave you a good enough background for a fun-filled answer to our question. Thanks again for making this podcast. All right. Lene, great job, first of all. 5349, $1.5 million saved in liquid assets, plus another $1 million in real estate.
That's fantastic.
They probably look like Joanne and Steve. What's his name? Fixer-upper?
Oh, yeah.
He's the remodel guy, and
Yeah.
she's working on the business. They're self-employed.
Yes, I know who you mean.
You know who I'm
Is that-
talking
I have
is it
no
Chip?
idea what you're talking
Is it
about.
Chip.
Chip. Yeah, Chip and Joanne.
Chip and Joanne.
Yeah.
Come on, Andy, get with the times. Yeah, they're from Texas.
Yeah.
And they're the Alaska version of Chip
Yeah.
and Joanne.
Yeah,
but
they-
it's
Are these
Leanne
TV
and
people, or is this? No, it's Lene.
Lene.
Get with the program, Joe.
They
Sorry,
do.
it's like your best friend.
Yeah, Chip and Joanne do fixer-uppers in Texas.
Yeah.
It's actually a pretty cute show.
Okay.
So the husband, he's a remodeler. He's buying some properties, fixing them up. Right? She's doing the vacation rentals.
Yeah.
Yeah, I love it.
Making lots of money. So they make a couple $100,000 a year, which is
Killing it.
fantastic.
Yeah.
Killing it. Now, if they live in Anchorage, that's kind of an expensive place to live, but they're still saving a lot. They're living on about $80,000 a year, so that's fantastic.
So the question is, all right, so 49 and 53. Going to retire. He's going to slow down a little bit in the next 5 years. All right, so they're going to retire young,
Yeah.
right? Or slow down. But they're not going to give up the vacation rental, so that's still going to bring in cash flow.
Right. They still have that, and he'll probably maybe do some fixer-uppers, but maybe not as much.
So if
So with the money, well, first of all, let's go over the IRAs. So there's $815,000 in IRAs, and of that, about $465,000 is inherited. You cannot convert an inherited IRA. You can only convert your own IRAs. Okay, so we'll get that on the table right away. So that's a little under $400,000 that's available to be converted.
So $200,000 of income. So the question is, all right, maybe we look at conversions, converting this to a Roth. How much should they do it all in 1 year? What are the things that they got to be looking at?
Yeah, here's what you might think about. First of all, do not do it all in 1 year because you'll be in too high of a tax bracket. But with this new Jobs and Tax Cut Act that we just had in 2018, the 24% tax bracket for a married taxpayer goes up to about $320,000. Okay, so let's just do the math. If your income is $200,000, and I'll just say you're using the standard deduction, we'll just round it to $25,000. So that means your taxable income is $175,000. So you could convert close to $150,000 and still stay in that 24% bracket. Now you only have $400,000 or so to convert, so we're not talking a ton. So you could do that much, or you could also, kind of stretch it out over a little bit. The taxes that we have right now are supposed to be in effect till 2025. So there's a few years to do this, and I would think that would be probably a good idea. But there again, you can only convert your own IRA, not the inherited IRA.
So at 49.53, they're going to slow down work in 5 years. We would probably want to take maybe a deeper dive in the tax return because they're both self-employed. Mm-hmm. So there's net income, there's gross income, there's deductions and things like that. So you're just kind of the back of the envelope, they could be in a lot lower bracket.
They
In a
could.
sense, they could be in the 22, and maybe you would just want to convert to the top of the 22. So what we would say is look at line 10 on your tax return, and then that tells you what taxable income that you're in. And then you could go to the IRS tables and see how much do you have room. So it's about $180,000 to the top of the 22% tax bracket.
Yeah, it's about, 170, I think.
178?
Yeah, something like that.
Ish. You got the sheet in front of you?
Yeah.
I'm calling it 180. And then
Oh, you give it to the old guy that can't read.
then I would convert maybe for sure to the top of the 22.
168. So see,
168.
I think they may already be in the 24.
I don't know that.
But
But
here's the thing. Yeah, in terms of being self-employed, you may potentially be able to do a much bigger retirement account. Then you could take some of your money market and then just basically jam that into a retirement account and convert that at no cost because you're getting a deduction and then you get the conversion.
Right.
So that could be we've done that a lot with self-employed business owners.
Sure. So yeah, you have $250,000 in cash, but maybe that cash is there to support the business.
Maybe.
If it's not, if it's there for retirement, then you could set up a solo 401k plan. You could set up a defined benefit plan. You could do all sorts of different things in regards to your self-employment in retirement. So set that, get your taxable income down low enough, and then you could do a fairly good-sized conversion. So
yeah, and to go even deeper, the best way to answer this question, how I guess we would look at it, is what are your tax brackets for the next 15 years or longer? And that's going to help you decide how much to convert. Because, Joe, we get this question all the time. Should I convert over 3 years, 5 years, 1 year? And it's like it's different for everybody depending upon tax brackets. And we do have sometimes people call us and they'll say, well, you guys always recommend Roth conversions, and we don't. There's lots of cases where we wouldn't. But in this particular case, because the tax rates are lower than they have been actually in virtually any time in my career, there is some real opportunity to get dollars converted in low brackets, even in the 24% bracket.
and they're young.
Right.
You know what I mean? And so you take some 22, 24%. Last year they would have, or 2 years ago, they probably been definitely in the 25. And
Yes.
they could push into the 28% tax bracket.
Yeah, Alaska, from my recollection, has fairly high, or no, actually it's a I was going to say high taxes. It's not. I think it's a tax-free state. So they don't have a lot of high taxes, so they probably wouldn't be subject to alt-min, but they would be probably in a 25 or 28% tax bracket under the old tax law.
Which is going to revert back in 2025.
That's right, exactly.
So
Yeah, they do not have income tax.
Well, hopefully that answers your question. But, you know, it's all vague. It all depends.
Well, that's always the answer.
You know what I mean? How
We
long
just
you
start
gonna
talking,
work?
and then we end up with, forget it.
Yeah, I don't know. Don't ask us. All right, we got Dan from Pennsylvania. I love your podcast. Listen regularly. Huh. They are very informative.
He's probably talking about another show.
I know, I was just going to say that. You speak frequently about Roth conversions.
That's YMYW.
Oh, really?
And
Okay.
there seem to be very few circumstances where you recommend against them.
Okay.
Well, Dan, you're absolutely correct.
I could think of many, which I'll go over in a bit.
All right. I wonder how you feel about my situation. Okay. Let's see what you got, Danny boy. 66, recently retired, fixed income, pensions and Social Security, dividends is about $140,000. Got a traditional IRA valued at $2.3 million. If I were to convert, all the money used to pay the taxes would come up from my retail accounts, which all have approximately 2/3 of their value in capital gains, which would therefore incur significant additional taxes. In addition, my Medicare premiums would be subject to surcharges totaling as much as $525 a month for my wife and I in the years we would do this. Does this still work for me? If so, what is the right amount to convert each year? All right. So is he retired? Yeah, sounds like it, right? $140,000.
66, recently retired, pension and Social Security and dividends about $140,000. That's fantastic. That's a great start. But he also says he's got a traditional IRA valued at $2.3 million, We know at age 70 and a half, Dan is going to have to pull money out. And at a 6% rate of return, that's going to be close to $3 million, I'm guessing. Is that what you're getting? At $3 million, yeah, we'll call it $3 million, then your required minimum distribution is about $120,000. So now between that and your 140, now you're at about $260,000 of income. So you're talking about higher Medicare payments. Well, that's for life. I mean, you can't really avoid it.
Yeah, you're done, Dan.
Right? Yeah.
That $520, that $175 you're enjoying today.
Yeah, it's not going to last very long.
You got 4 more years of that.
So, but what Dan's talking about is at certain adjusted gross income levels, you have to pay higher Medicare taxes. There's a 2-year look back. So right now in 2019, people are paying from what their income was in 2017. So, and just so you know, what those adjusted gross income amounts, and Dan is Dan married?
Yes.
Did he say?
Yep.
Okay, good. So being married, then I'll just go over a couple of them. If you make $170,000 or less, then you're in the lowest Medicare bracket, and your Part B premium is $135,000, and your Part D, which is for the drugs, is at $0. If you get over $170,000 to $214,000, I'll just do Part B. It gets to $189. If it's over $214,000 but below $267,000, it's $270. $267 to $320,000, $1,000 of income, it's $352. The point is, the more income you make from 2 years ago, it's going to impact your Medicare premiums. But I'm going to say this, Dan, you're going to be in these high Medicare premiums regardless of doing nothing. So what might be a smart thing to do is to perhaps convert. Maybe you convert up to adjusted gross income of 267, let's just say, to keep out of a potentially higher Medicare bracket. But
Probably 250.
Honestly, when you do the math, though, the extra Medicare taxes that you pay compared to the lower tax brackets that we have today, I don't think are going to make me want to have a different decision. Now, on the other hand, if we were in the old system, 2017 and before, this would put you into alternative minimum taxes probably, and so I would probably have a completely different answer.
So another concern of his, though, is like, when I convert, I got to pay the tax from my brokerage account, and then he's got capital gains tax that he's worried about.
Yeah.
So you don't do anything, you're just going to pay a lot more ordinary income tax.
Yeah, later.
So then you got to look out, maybe you do 250 or something less just to stay out of the net investment income tax.
Yeah, that's another good threshold, right? And that keeps you under the 267 for that next Medicare bracket. So the 250,000, once you're over 250,000 as a married couple, adjusted gross income, now you have to pay an extra 3.8% Medicare surtax on your passive income, which is interest, dividends, capital gains, rental income, and the like.
Yeah, I guess it's Dan's belief to look at where does he believe if tax rates stay the same or go up, it probably makes sense to do conversions. If he believes tax rates are going to go down, then don't do them.
Yeah, well, that's always true, right?
Right?
Yeah, but let me just.
In his situation, he's a prime candidate.
Yeah.
But I think he was focusing on, a lot of times too, people trip over, what is it, dollars to pick up pennies?
Yes, I think that's how you say it.
And I think that's what Dan might be looking at, because he's like, well, if I convert the whole thing, $2.3 million, it's going to cost me. You would never want to do that.
Yeah. Let's go over that just briefly. We would almost never recommend converting your entire IRA, because what would happen is it would put you in such a low bracket. You pay taxes at a much higher rate to stay in a much lower rate. What makes more sense is to convert enough just to stay out of higher brackets, but you want to have enough IRAs to fill up and required minimum distributions to fill up those lower brackets. I think that's a huge misconception. We really don't advocate converting at all. It's just how much you convert is going to be based upon your tax brackets today versus in the future. Like I give you an example. I was just talking to a person where when we look at their retirement income, her retirement income, single taxpayer, she was barely in the 22% bracket at age 70 and a half, and then by doing just a few conversions, now we can have her retirement income be at the top of the 12% bracket. So it's just enough conversions to stay in a lower tax bracket in the future.
Right, and then you kind of take a look at, all right, well, What other? There's so many different variables. I mean, I get it, Dan, because I think we like to talk about certain strategies that make the biggest impacts on people's lives, and we talk about stories in regards to taxes, Roth conversions, and blah, blah, blah. So it might sound like that's all we want people to do. But people just hear snippets of stuff, too. And they're like, oh, well, maybe I should do a conversion. And it's the absolutely wrong thing.
Right.
So giving us more details, such as you have so eloquently here, I think you make for a prime candidate to do a little bit of a conversion.
But not all of it.
Not all of it. No. You want to say something?
No. That was it. I was just pointing out there's a couple of short things that you could do if you have,
I thought
30
Alan was
seconds or
going to,
something.
because he likes to continue on.
Right.
Yeah, but
And then I was doing this to her, not to you.
You were already giving me
No. I was saying to her, I was like, no, I'm not going there because Big
Too much
Al.
sign language.
Because Big Al wants to finish the story.
I wanted to, but you cut me off.
All right, great question, Andy. Great job, Big Al. Wonderful as always. We'll see you next week. Show's called Your Money, Your Wealth.
Big Al didn't get a chance to go into situations where they don't recommend Roth conversions, but Dan is right. It's not something you often hear on YMYW. In the show notes, I have linked to the one episode I can recall in recent memory where they did say that they would not do a Roth conversion, but I want to see if you can come up with others. Click the link in the description of today's episode to go to the show notes. You can listen to the episode in question, and you can hit that Ask Joe and Big Al banner to send in your situation and see if the fellas say, I would not convert for you too. Your Money, Your Wealth is presented by Pure Financial Advisors. Click the free assessment button at yourmoneyyourwealth.com to sign up for a totally free 2-meeting financial assessment, either in person or via web meeting, with a certified financial planner from Pure. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Andy got a compliment. Did you hear about this one, Big Al? Helen, that just wrote in, was asking us about Roth IRAs. She's like, I love your voice. Very warm and sexy.
And the humor.
And the humor when you react to Joe and Big Al.
I was letting the sexy settle.
Let's just move on past that.
So you got to let that sexiness just settle in the room. Big Al's get uncomfortable.
Thank you, Helen. I appreciate it.
It's I'm just thinking about church. doesn't jive with that. Actually, my wife, my lovely wife Annie, just went to a presentation at our church last night, which I couldn't go to, but it was on loving your neighbor as yourself. So I got a little lowdown on that.
All right.
And so I learned how to love you better.
Okay.